Hi, and welcome to Data Talk. Our podcast covers all things data collection, web scraping, and analytics that will help you and your business become more data-driven. I'm Philip Burns, Growth Marketing Director at Bright Data, the data collection and proxy network. Hi, and welcome to episode 3 of the Data Talk podcast. With me on the other side of the world, my American counterpart, Omri or Gad. How you doing, Omri?
Hi, good morning.
How's the weather over there?
Chilly. We're waiting for March to finally end, and maybe we'll see a little bit of warmth. But New York is opening up. It's great to see.
Nice. And today we're very excited to have a very special guest with us, Daniel Rix-Standing of EMK. Daniel, thank you very much for taking time out of your day to speak with us about all things data. So let's jump straight in. Daniel, just tell us a little bit about yourself, like your background, where you're from, where you are now. Let's get to know you a little bit better.
Thanks, Phil. It's great to be here. So I'm in the investment team at EMK Capital. So essentially it's my job to source interesting investments, try to execute those deals, and also to participate in our portfolio investments during the whole period. So I've been working with EMK for 5 years now. And before that, I was a strategy consultant. And I also did a bit of work in investment banking. So I've done a few different things within the world of finance. I guess I'd be lying if I said I sort of always wanted to be an investor, but I think fairly quickly after leaving university and starting to work in finance, I was attracted to the idea because I think as far as finance goes, investing in equity, which is the sort of core instruments behind ownership of a business, really is the sort of purest form of decision making in finance, because you're simply trying to understand, what the future of a business looks like. And decide on a risk-weighted basis, what is that worth? So I think it's a very broad profession, and you have to deal with, all these kinds of high-level questions about the future, which are very difficult to answer, but quite interesting.
Before we go into some of the details, what led you to investing? You said you started in finance, and now you're in investments. Was that kind of a natural path? Were there specific events that were at crossroads that led you into your current role?
Yeah, absolutely. So to be honest, I started working in finance more out of a lack of imagination than anything else, because it's what a lot of people around me at university were doing. But then fairly early on, when I started working in investment banking, I actually met some people who worked in the investment division of the bank in question. And to be honest, I found them, very interesting. And I thought they looked at the world of finance in a way that I thought was more sort of, intellectually honest than some of the other bits of finance, where I guess, you're on the sell side, you're trying to sell, securities and financial assets to people. I thought that being a buyer was actually possibly the most interesting part. And so at that point, I sort of decided it was something I wanted to do. And then there was a little bit of a journey to getting there, because typically investment firms don't hire people straight out of university. You have to do a few years of either banking or consulting, or in my case, a little bit of both before making the move.
Would you say there's a specific trait in people that end up on the buyer side? You mentioned that you met people that were in this industry. Was there any specific traits that you think tend to be common?
It's a very good question, and I guess you get a lot of different types of people. You get some people who are very much all about the detail, and some people who are a bit more sort of concerned with, the bigger picture, and sort of more kind of long-term trends and a more holistic view. But in general, I think investing attracts people who are quite sort of interested. They like learning, like picking up new things, because I guess it's a very broad profession. You have to do lots of different things. You sort of do little bits of being a lawyer, an accountant, a headhunter, all sorts of different things. I think it tends to attract quite cynical people, because I guess it's your job as a buyer to sort of interpret what you're being told and decide which bits of it you think are sort of justifiable and which bits aren't. And I guess you get people on the sell side who are very good at presenting a business in the best possible light, and it's your job to try and assess what's really there and what isn't, if that makes sense.
How do you see the data that's coming into public companies' evaluations as opposed to private companies' evaluations?
Public companies have been using data, or sorry, I should say, investors in public companies have been using data in a more sophisticated way for longer than investors of private companies typically. And I guess the reason for that is, public company investing is all about finding any little edge, any little advantage that you have. And once you've found that, and you can price a stock better than other people, then you can apply that over and over again and keep benefiting from that information until other people find that information out, and the information becomes sort of priced into the stock. So it's all about finding these little edges, here and there. Whereas, and I guess, one thing to say is that I guess there's a relatively small universe of companies you invest in. So, most people in hedge funds and other sort of public markets investors, they will have a specific area that they cover, and they will dive into huge detail in that area and try to find every little advantage with every lever that they can. Whereas private investing, by contrast, you don't have access to the same company again and again and again. So every deal that you look at will be a different company. Sometimes they'll be in the same industry, so you can apply learnings and in some cases, data sets across those different deals, but it's typically very bespoke to the situation at hand. And I think what that's meant is that the use of alternative data, which is all about finding that last little advantage, that has been slower in private markets investing, if that makes sense. But it's definitely there now.
Daniel, do you think the alternative data has brought any sophistication, or better said, what is the change that alternative data brought into the trading of private companies?
I think what's happened is you've just had an increasingly competitive environment. So it used to be that, there were maybe 100 private equity firms across, Europe and the US with a certain amount of capital. I don't know exactly how much, but it'll be a good number of billions. And what's happened over the last, 20, 30 years, but particularly in the last 10 years as well, is that more and more money has rushed into that industry. And that's meant that funds have tended to get bigger, and also you've got more funds as well. So there's far more people and more capital going after a relatively similar number of companies. And that means that, to sort of massively oversimplify, whereas once upon a time, if you were in a really sort of typical basic auction process for a company being sold that expected to sell to private equity, you might be up against 3 or 4 other private equity funds. Now you might be up against 10 to 20, depending on the country and the type of business. So it's got increasingly competitive, and alternative data has been one of the really important tools behind funds trying to differentiate themselves, trying to go that bit beyond the basic information that everyone is given. And I guess this goes a little bit to sort of the process of how these M&A processes are run. But essentially, there'll be a data room, and there'll be data provided by the company that's being sold about itself, saying, this is information you can look at to try and put a value on our business. And everyone gets that information. It's made available to all the bidders. And as a result, you can price the company better. You can, value the business more accurately by analyzing that data better than everyone else. But that's quite difficult. And once you've got a large number of funds all competing, the chances of you having the winning advantage by doing that is actually relatively low. So bidders look for other sources of information they can bring into the process in order to make themselves more competitive. And an obvious example would be something like, for any kind of consumer business, you can go to social media, you can go to review websites, and you can collect a huge amount of data on essentially the sentiment of consumers and potential customers of this business towards that company or that company's products. And that allows you more information that maybe some of the other bidders don't have. So I think it's a response to competitiveness, and essentially it allows investors to try and differentiate themselves and be more successful and value companies more accurately.
When you sit, I assume that when you sit in a room full of data sets and full of financial reports, it's very easy to get lost. So probably the first thing you do is kind of assess, okay, this is a good data set, this is a bad one, this makes sense, this doesn't make sense. How do you go about it?
I guess it depends a bit depending on the investor and on the investment in question. So, hedge funds will have a particular set of requirements that they have for alternative data. And I don't know the details of how they would look at it. But from a private equity perspective, by far the most important thing is that the data is available and it answers your specific question. And this goes back to the point about every deal being different. When you're a private markets investor, you won't know in advance exactly what question it is you're trying to answer. And then you'll find yourself in a deal process where you're trying to value and hopefully acquire a company. And then you'll find all these questions getting fired at you. And because of the way these processes are run, where there's a lot of time pressure on you to come up with your valuation and put your best valuation forwards in a short time frame, you haven't got long to go and scout around and try and find what the best the best ways of answering the questions, what the best data sets would be. So being available and actually answering the specific question, I think, are key. And I guess one way in which a private markets investment can be easier from a data perspective versus the public markets is that you only need the data to be available once, because you make the pricing decision once and then you have to live with it for the next few years. And so you can actually essentially commission your own data collection exercises if that's helpful. And there are a few different companies that will do this for you. So actually you can go and collect data. So data doesn't have to be available sort of immediately and upfront, but it's extremely helpful if it is, because of the tight time frames that you're working under. And I guess perhaps the only other thing to add is, obviously you'll have a lot of different questions to answer. So, maybe, do customers of this business generally like the product? Do customers of this business identify, X, Y, and Z issues? You can also have more sort of specific questions like, what do we think the revenue of this business is likely to be next quarter? And, what do we think the price of this particular commodity will be next year? What do we think, the market for the customers of this business will do? So if it's a B2B company that sells to a particular type of business, then understanding the fortunes and prospects of the end customers of this business could be important. So there's lots of different questions you can answer. And so most importantly, just having data that actually addresses the point in question or is a close proxy to it is sort of the most important thing.
You said something really interesting, and I'm going to jump in with a question, is that we're talking about alternative data, and I think there were two specific types of data. It was the financial indications of predicting revenue or revenue growth. And there was also the sentiment of the customer, how they connect to the company itself, or the feelings towards a specific brand. Does one or the other have more value in your decision-making process?
Yeah, so I guess, it's a sort of shame to admit it, but the truth is that what really matters is the financial data that will actually materialize in the future, if that makes sense. So future financial performance, that is pretty much the most important thing for most investors. Not all investors nowadays. There's a whole movement into impact investing, where you measure the return of the investment in other more holistic ways that include sort of social and environmental value. But if we talk just about traditional investing, then that sort of future financial performance is the key. And I guess anything that helps you predict what that's going to be is important, and the better it helps you predict it, the more important it is. So alternative data is usually used as a kind of leading indicator for that financial data. In the case of, what is revenue going to be this quarter, you probably won't find out that information until a few days or weeks after the end of the quarter, because the company takes time to close its accounts, build its financial statements and report to its management or its investors or whoever. Whereas if you have data from payment processing companies, you can see that, last quarter, for example, the company, had this number of payments or this volume of payments or whatever it might be, or this company's sector had this volume of payments if it's anonymized data, and this is what the revenue the company had that quarter. And then you can say, okay, well, this quarter we have payment volumes of this, and so we can make an estimate of what we think the revenue is going to be based on that. So that's a very direct relationship between, data and what we're trying to forecast. And then I guess the other example that you asked about with sort of sentiment data, that is a much more indirect connection, because there are a lot of things that impact whether people go and buy products. And this is obviously thinking about a consumer business here. Obviously, it's a little bit different for B2B businesses. But there are a lot of things that impact consumer decision making and purchasing. And one of them will be the sort of general sentiment or feeling or sort of vibe towards a particular product. And you measure that sort of general feeling and whether they have positive or negative sentiment. And that allows you to make some inference and projection about the future and whether they're likely to buy or not in the future. But the truth is, that person could say, yeah, this is a great product, I love it, but I've already bought it. And so it's completely irrelevant what they think. And what really matters is the views of a much smaller subset of people who maybe aren't currently expressing their opinions because they haven't bought a product, and so therefore have no reason to go to, a review website or express their feeling about it on social media. So obviously you'd expect a connection of some sort between the two, but I guess I'm just trying to illustrate that this would be a much less direct link between the alternative data and the thing that investors are really trying to measure, if that makes sense.
Does it make a difference whether it's a consumer-based business or a B2B company in terms of the sentiment of the customers? I imagine that it would.
Absolutely. So it's much easier to measure sentiment of consumers via sort of automated data means, because they're much more willing to express their views publicly. So nowadays, everyone shares things on social media, people write, reviews, everyone's happy to share their opinion, whereas businesses, generally speaking, are much less likely to sort of put out their opinion sort of publicly available for other people to see. I guess the sort of flip side to that is that businesses are usually easier to access because you know who they are. They have a business, they have a phone number, they have an address, they have people who work for them. So you can sometimes actually just call them up and ask them what they think. Usually via advisors or through some sort of anonymizing system, so people are kind of happy with the information that's being shared. But I guess in that case, you would approach it in a different way. So you'd actually speak to individuals about their views, whereas when it's a consumer business, typically, this idea of sentiment analysis is much more relevant, if that makes sense. But I guess sentiment is just one type of alternative data. There are loads of other types that apply just as much to B2B businesses.
We see a lot of investment firms and quant funds and hedge funds building tech teams within the firms themselves. Do you see that as an advantage in the private equity? Do you see private equities that have their own tech teams and data teams get better deals, perform better? I don't know, maybe get a unique deal out of the crop?
I think in the case of the public markets, it's absolutely crystal clear. In the case of the private markets, it's still a little bit earlier to tell. And I guess the returns of private equity investors are not as easily accessible. They're often kept very private. So it's hard to know to the same extent, who's winning what and why. So it's a much sort of harder judgment to make. And I guess it's generally a bit earlier in the journey. So I think the extent to which these data science teams will become widespread across the private equity industry is maybe a little bit more uncertain. But personally, I think the case is extremely strong. And you're seeing a lot of, especially the larger investment funds that have more of a sort of ability to deploy these people across lots of different companies, investing substantial amounts in hiring these teams. So I guess it's a little bit hard to sort of pinpoint specific things, because things are often kept quite hush hush in private investing. But I'm personally pretty confident that it will continue to become a feature of the industry.
You talked about sourcing through third parties. And we know that the bigger firms are establishing their own tech teams. What is the confidence level that you have on the data sets that you're buying from third party in order to make such a core decision? And how do you measure that confidence?
That's a really good but really difficult question. And I guess it varies very much from deal to deal. If you've got any kind of data set that you can correlate to the data set that you're looking at, so if you can see a history of what you're trying to measure correlating with the data you have, then that obviously provides a high degree of confidence. However, I guess in a lot of cases for private equity deals, because this isn't a company that you'll have been tracking, for a long time and watching the data set and the data feeds for a long time, it's something new that you were first introduced to maybe a couple of months ago. Then in that case, you have to make a much more kind of holistic assessment. And so I guess you have to firstly just think through intuitively, do you think X and Y should be correlated? Do you think there's a relationship between these two data points that you're looking at? And, I don't think you should ever look at one data point individually unless you're really confident in its validity. I think it's really important to look at lots of different data sources. And I guess, that question around confidence in the data that you're looking at is really important, because, there are all these data sets out there, lots that you can buy on Amazon Data Exchange. And a lot of them either aren't necessarily measuring what you want them to measure, or in some cases, they might be just straight up incorrect. And so having, a source of data that is truly reliable is extremely important. And I guess, if you've worked with a data provider before, or if you've got a sort of established process for collecting data and you have confidence in that process, that can very much give you confidence in the sort of process of the data, that the data you're receiving is right. And then I guess you have to make an internal decision about whether or not you think that data is kind of answering the question that you wanted to, if that makes sense.
I think we can talk about sourcing as well, because when you look at the public markets, I think it's very easy. To some extent, at least the shortlist is very easy. Either you're pre-IPO, post-IPO, traded, whatever you want to call it. In the private sector, I think it's a little bit different. How do you see alternative data contributing to your deal sourcing?
So that's a very good question. Sourcing is one of the main challenges that private equity investors face today. In the face of so much competition from other investors, if you can meet a company or develop a relationship with a company or a dialogue with a company prior to other competitive investors finding out about it, you can essentially get an advantage in an M&A process when that happens. Now, obviously, you need to set your net wide, because you don't know when these companies are going to come up for sale and actually have an opportunity for you to invest in them. But it's absolutely critical to be out there trying to find interesting companies that are relevant for your investment thesis and try and find them before other people do. So this is where alternative data can play a really big role. And I guess there's lots of different indicators that can suggest that a company might be considering an M&A process or seeking new investment. And it depends a little bit depending on the type of company you're looking at. But if we think about startup companies, for example, so earlier stage companies, maybe they're not profitable yet, so they need to go to the market to raise capital every so often. So using data collection techniques, you can actually collect data on all those different fundraisers that have happened in the past. There are sort of public web pages that include all of this information. So what company has raised how much capital, when did they do it, based on the number of employees that company has, which is also available online. Roughly how long do you think it takes for that company to burn through its capital and need to go and get more capital from the market? So obviously it's still guesswork, because there are a lot of variables that you won't know, because these are private companies, but it really helps you narrow down the list, and it helps you take the funnel that may have been 3,000 companies down to maybe 300 companies, and then you can look through those and decide which you think are relevant for your investment strategy. So that's one example, but there's other things you can do as well. I probably shouldn't go into all of them in detail. The previous one's fairly well understood.
It's not a private lesson in private equity here, so it's fine. Yeah. You feel you have questions? Go ahead.
Where do you see the next 10 years going, and how is the influence of alternative data going to affect private equity?
Absolutely. So I think it's only going in one direction, and that's for much more use of alternative data. And I guess that's driven by the sort of competitive dynamics that we've been speaking about so far. So you start with the information that is given to you by the company you're assessing, and then you go out and try and collect more information to make yourself better informed than everyone else. And it's a little bit like, if you think about in the context of a public company, the share price. So theoretically, all information that is publicly known should be built in to that share price. Now, of course, it isn't, because the market isn't perfectly efficient and whatnot, but that's what the sort of theory would tell you. So once information is public, then if you know that information, it doesn't put you at an advantage, because everyone else knows it too. And so the share price reflects that information. And that dynamic plays out in the context of a private equity investment too. It doesn't play out in the sense of a share price changing every day, but it plays out in the sense of what the price that would ultimately clear the market and secure a deal would be. So obviously there's a lot more volatility in it, because it's sort of deals that happen infrequently and they're different each time. But ultimately it comes down to the same thing, in that the sellers have lots of different buyers they can go to, and unless you can really differentiate yourself in some way, which is possible but is not always possible, then you're essentially competing on price with other investors. And at that point, any information that you have that they don't have gives you an advantage. And the minute that you have that information and you've used it once, the chances are other people are going to figure it out further down the line. And then you have to go and find new information again that other people still don't have. And so you get this competitive cycle that just drives more and more information being used to value businesses. And this is what's been playing out in the public markets, and it started to play out in the private markets too. But because of those competitive dynamics, I don't think there's any question about the direction that it's going to go in.
So the game is basically asking the right questions and answering them fast. That's the
Absolutely.
Game now. Very interesting.
Absolutely.
I think
and having data that you trust, having sources that you can trust.
I think part of the way, at least what I see in the data market, is the way that questions are asked usually determines the trust that you get. Because if you don't understand the question as a supplier, as a vendor in this market, there's no way you're going to answer the question. You have to kind of really understand what you're being asked, and then that's the only way to provide the right data sets that create trust later on and down the line. In the venture capital market, all the VC, they're probably doing far more deals than you are doing, and the deals are smaller.
Absolutely.
But how do you see the difference between you guys and the venture capital market?
Absolutely. So I think the use of alternative data has maybe come actually earlier for venture capital investors, but on the sourcing side rather than the company valuation side. So for an early stage business, the valuation is a very hard thing to do sort of really detailed analysis of, because the future is very uncertain. The business could become hugely valuable or not very valuable, and you try and value it as best you can, but it's very difficult to do precisely. And that's where the alternative data usually comes in, is in trying to make more precise determinations. So venture capital investors use data very effectively, but for sourcing investments as opposed to executing investments. And that's where what we were talking about before, where you can essentially collect a database of lots of different company names, and then you can collect data on those companies, like when did they last raise capital, how much did they raise, who are their current investors. If you're an experienced venture capital investor, you can spot patterns that imply that a company will need financing, or that a company has been performing well or has been performing badly. And sort of obvious things would be, the rate at which a company has been hiring employees. Companies that stop hiring employees, if they're early stage companies, typically aren't doing that well. Ones who are hiring quickly typically are doing better. So that's a very obvious one. There are more kind of nuanced insights you can draw, but that's just an example, if that makes sense.
Very interesting. Phil, do you have any more questions?
Yes, as a marketer, I have like this big kind of passion or belief in marginal gains, and it's part of their DNA as well. Continuous small improvements contribute to a big difference. Now, I learned this from sport, British sports. Do you encourage your investments to use data in order to get a competitive edge in their industries?
Absolutely. So every business environment is competitive, and especially when you invest into growing areas like we do. So typically, pursuing transformational growth, there's often even more competition, because there's lots of people who also see, what's attractive about that market. It's similar to an extent to what we were talking about before, where you have investors competing for a share in the case of public markets investing, or to acquire a business in the case of private equity investing. In that, if you're marketing and you're trying to reach the same consumers as your competitors, or business customers as your competitors, and you have a certain marketing budget to deploy, the more information you have about those customers, where they are, where they're susceptible to marketing, what they are interested in seeing, what they're likely to respond warmly to, that information can be used to deploy your marketing budget in a far more efficient manner than your competitors, and essentially lead to competitive advantage and an outperforming your market and making your company a lot more valuable. So I think the analogy is exactly the same, and as a result, I think that's led to a significant sort of creation of a category of alternative data for companies and marketing departments, on top of all the other areas that we've already discussed.
It's been very interesting, I have to say. It's
Definitely
an insight to a lot of stuff we do anyway, but it's that's the real deal, like listening to what you've been going through.
Yeah, Daniel, thank you. It was, I found it very interesting. I don't know if the questions were on topic, but for me personally, I thought it was really good. So thank you very much.
Great. Thank you very much for having me and for listening.